Good day and welcome to our first Eurasia Briefing. This briefing will look at the impact of the evolving COVID-19 crisis, but also the effect of lower oil and gas prices in some economies and the contagion that's causing across the region in terms of lower remittances, but also the broader impact of reduced global trade and reduced tourism, of course, which has been a big factor in the region. So what has been the impact on the economies across the Eurasia region, and what can we expect from here? This briefing is an overview. As I said, it's our first one. It is accompanied by a summary presentation, which will have more detailed numbers and forecasts, some of which I will show here. There's a lot more in the presentation, so you should have received that. If you haven't, then please let me know and we'll send you a copy. It is our intention in the next few weeks to follow up with more country-specific presentations, drilling down in greater detail what's happening in all of the countries in the Eurasia region, which includes that whole area between Ukraine in the west, Mongolia in the east, through Central Asia, the Caucasus, but also we cover at a macro level Iran and Afghanistan, and we will be covering both those countries in this series as well. So looking at the Eurasia region first, we have now extensively reviewed all of the economies in the region, and this is our first kind of run at the revisions. It's still very clear that it's too early in the process. The COVID-19 crisis is still evolving. We still have no real certainty as to what's happening with the oil price and therefore what's likely to be the contagion from that in the region. So this is the very first run at forecast, and I have no doubt that we'll be revising these numbers again in the next few months as we go through the year. And hopefully by the time we get to the autumn, we will have a much clearer idea of what to expect, at least a narrower range of what to expect in 2001, 2002, 2003. And as you know, we always run detailed 3-year forecasts. We use scenarios for all of the countries based on different inputs, showing us kind of optimistic, pessimistic, and base case forecasts. So we use base case forecasts in these numbers. And as you can see across the board, out here on the right was our previous 2020. This is it seems like a long time in history right now. We were looking optimistically at the region, and these have all been massively scaled back. There are still a couple of economies that can expect to have positive growth. Armenia coming rattling down from nearly 8% growth last year to 1%. It's still positive. The Kyrgyz Republic has benefiting from the fact that it's a big gold exporter. The gold price has held up. Demand for gold has helped the economy as we expect it to remain positive. And Turkmenistan, where the numbers are always a little bit suspect, it has to be said, there's kind of a lack of clarity in the numbers and in the reporting, but still we would expect the government to report positive numbers. And Tajikistan also, I mean, if you look at the map of where Tajikistan is, tucked right away and right there in the bottom sort of southeast corner of Central Asia, it's one of the most isolated countries in the world, and to that extent it has been relatively protected from the COVID-19 crisis. The economy is not that open to the rest of the world, and therefore we would expect kind of a modest positive number. And Uzbekistan, which is, we know, a very fast transforming economy, has been really galloping ahead in the last several years since President Mirziyoyev became president, and it'd be a lot less in terms of what was expected. With Uzbekistan, the big hit there is in tourism. And actually, if I go through these numbers just to highlight what are the main areas, what are the main problems. So in Armenia, it's a big hit on tourism. The country was developing tourism. Also, its biggest export is copper. And of course, the demand for copper, particularly from China, and the price of copper has collapsed as industries around the world have shuttered or have slowed down. So tourism and copper are the big two problems. Domestic kind of demand is keeping it up. Azerbaijan is an oil or hydrocarbon economy. Of course, it's taken a big hit because of that. It also has a fixed currency, so it's not able to benefit from currency devaluation. But it is mainly the oil and gas hit here. Belarus is one of the hardest hit, as you can see, over 1% growth in 19. We were expecting around the same this year. Now a big reversal to minus 5%. The problem with Belarus, it has lost the subsidies from buying cheap Russian fuel, refining it and selling then the more expensive product to Europe. First of all, that flow of oil from Russia was already stopping as Russia changes the way that it taxes its oil extraction, and also the political row with Belarus means that it has in any case been slowing down. But also the demand for product in Europe has collapsed. Belarus also has made a great deal of money in the last few years as a transit country for goods from Europe into Russia and vice versa. And again, that trade is largely now, well, has substantially slowed down. So across the board, Belarus has taken a big hit. Georgia, its tourism to a large extent, of course, exports of Georgian products, of course, famously Georgian wine, but also other Georgian food products have also slowed down, leading to this contraction of the economy. Kazakhstan is an oil and gas economy. They have a big development program, of course, to modernize the economy, to focus on minerals, to focus on agriculture and food, but that really is happening very slowly. So again, a big hit in the economy, but it's mainly oil and gas. Kyrgyz, I mentioned, benefiting from the fact that they have resolved their dispute with Centera, the Canadian gold mining company. So one of the biggest gold mines in the world is the Kumtor mine in the Kyrgyz Republic that is operating, we understand, at full level, and of course demand, the price of gold is holding up. Mongolia is also one of those countries that can stay with a positive growth, well down on last year. Mongolia was hit hard early on because 80% of its exports go to China. A lot of this is coal, some other minerals as well. And of course, as China slowed down, significantly in the first quarter, then the Mongolia was hit back then. It's starting to recover now as China is recovering. So as we get the second half of the year, what has been negative growth or contraction in the first half should turn positive, give us a positive number for the year. In Russia, it's we had seen the first quarter numbers picking up very strongly. It was on course for at least 2% growth as we were looking for this year, led by consumer sector, led by budget spending, construction sector, which is showing positive growth for the first time in years. And unfortunately, just has come to a hard stop in this quarter as the economy has gone into lockdown, like most other countries in the world, and we would expect to see major revisions to budget spending. But at least the case of Russia, it's in a good position financially. The government does have resources. And despite all of these kind of almost daily reports, how Russia's going to fall apart and Putin's going to lose power and the economy's going to collapse, that simply isn't the case. There's no evidence to support that kind of political, emotional reaction or reporting. Russia has financial resources, is relatively stable. It will take a hit, but we're still looking at a recovery next year based on our assumption of COVID and oil price. But again, all subject to review in the summer. Tajikistan, as I say, relatively isolated, is benefiting from some exports, but of course the whole big issue in Tajikistan is the development of the Rogan mine, which is the world's highest elevated hydroelectric project. It's been under construction probably for 50 years, stop-start, mainly stop. But now at least the momentum is to build it. It is a big part of the Asia Development Bank's CASA 1000 program, which is essentially to generate electricity in Kyrgyz Republic, Tajikistan, and export it into Afghanistan and Pakistan. So there's a lot of money now going into these projects, into developing this dam. It is ongoing, doesn't appear to be slowing down. Turkmenistan, as I say, there's always difficulty with the numbers. It is also a hydrocarbon economy, principally gas sales to China. Took a big hit, obviously, in the first quarter. Might recover later in the year, but struggling. And clearly the numbers coming out, or the anecdotal evidence coming out of Turkmenistan, is that they are really struggling. Ukraine will likely be the first country we will cover in detail. Right now, the whole issue in Ukraine is to get the Funding from the IMF, the government has released revised growth and budget projections for this year, fairly aggressive on the negative side. But again, I think a lot of that is to try and keep pressure on the IMF to sign off on the $5 to $8 billion of funding that the country needs this year. Otherwise, essentially, they're saying they will need to default and debt and will have a crisis. So I think politically, this is a done deal. It's just a case of getting the outstanding legislation, which is the bank reform legislation, principally, get that done. And Uzbekistan, say, well down what was expected, taking a big hit in tourism, big hit on areas like horticulture, which looked like we're going to be very big growth areas of growth contributors for Turkmenistan, or sorry, Uzbekistan. They've all taken a hit this year, but there is underlying momentum on the economy, and that will at least see it positive. So in terms of the next, here we can see on the currency side, and this is one of the other issues across the region that's common to countries. The Russian ruble has taken a hit with the oil price. It was down 18% a few days ago as the oil prices collapsed. That has led to the Kazakhs having to devalue because part of the Eurasia Economic Union, they've got an open border with Russia. They learned that lesson in 2015. They need to stay competitive, otherwise people simply cross the border to buy goods. But also, of course, Kazakhstan is a hydrocarbon economy and needs to devalues its currency in order to try and improve budget situation in tenge. But they have to be very careful because Kazakhstan is one of those countries with a high level of dollarization. So they really can't afford the currency to collapse too quickly by too much. Otherwise, you'd have another banking crisis. Nevertheless, they have to stay competitive. We see the same thing in other countries. Belarus, of course, also having to remain competitive against the Russian ruble. And then across the region, we see Ukraine currency. Uzbekistan was holding up quite well, but they've had to devalue recently. They cut the refinancing rate from 16% to 15%, even though inflation still is around 15%. But they need to remain competitive, and they need for export competitiveness as well as domestic competitiveness. And they do a lot of trade with Iran, and you can see the Iranian, the Toman, which is the kind of new version of the rial, having to stay more or less in line with that. The Tajikistan kind of has a managed currency, hasn't been too badly affected. In Turkmenistan, I should mention that officially the manat is at 3.5 against the dollar, but we use the street rate, the commercial rate, and that's down 5% this year, having collapsed badly last year. And that's a huge issue for companies working in Turkmenistan. Again, we will deal with that when we come to looking at the deep dive or the drill down into Turkmenistan in the next couple of weeks. But essentially, the problem for foreign investors is that you bring money in dollars and you have to convert it at the 3.5 official rate, and then you've got to spend it at the street rate. You can see the problem straight away. So we'll delve into that. The Azerbaijan still has an almost pegged currency against the dollar, 1.7. I do believe that they will be under pressure to devalue that later this year for competitive reasons and for budget management reasons, but right now they're still sticking with it. But this contagion in currency across the region, again, affecting investment, affecting inflation, keeping rates high, and generally slowing down investment in the region. The other problem then, of course, is budgets. We've had to substantially revise, and on the downside, you can see all countries are now expected to run at budget deficits this year. So it's partly on the oil side. If you look at Azerbaijan, Kazakhstan, Turkmenistan, and Russia, it has reduced remittances. Countries like the Kyrgyz Republic and Tajikistan are very heavily dependent on worker remittances, particularly from Russia. But Uzbekistan also still has a legacy of remittance dependency. Armenia and Ukraine also, it's a significant amount of money, less critical than in Central Asian states, but still important. So the reduced trade, reduced foreign currency earnings, reduced hydrocarbons, I mean, basically this is what you've got. And some of these countries, of course, also having to substantially increase payments to support their economies, to support populations at a time when income is going down. It's no surprise that we're getting this hit across the board. And say this is a first run. We would expect that we will see more budget details from governments in the next couple of months. And then finally, just across the board, looking at debt, because of course this has all this revised The budget deficits have to be paid for, and they will be paid for with higher levels of debt. Ukraine, of course, is in the most critical situation. It needs 5 to 8 billion from the IMF. As I said, I expect they will get it, but it's driving up debt levels. Uzbekistan has also applied for additional debt, but it's got a relatively low debt base to start with. Remember, the country effectively only opened up 3 or 4 years ago. So it came with a low level of debt. And even though it's been adding more debt from World Bank and Asian Development Bank and had its first Eurobond issue over a year ago, it's still comfortable enough. Russia's debt, of course, is the lowest in the region. Again, the legacy of sanctions, which we do have a separate Russia briefing. And so you will see more details about Russia in that briefing, which you can download from our website also. But Mongolia is now also applying for additional debt. It's under IMF management, as we know. This is the kind of national debt, but total country debt over 200%. So they're having to revise their debt level. And Belarus, President Lukashenko has had to ask the EBRD, the IMF, and also Russia for additional funding. Which leaves them in a precarious political situation, which again I'll deal with in more detail when we come to Belarus and the drill down. But a lot of countries having to borrow extra money. The ones that don't are those that have got savings from their hydrocarbons. So Azerbaijan has got good reserves in the Sofas fund. Kazakhstan has got good reserves in the sovereign wealth fund, the Samarkand fund, and Russia's got good reserves. Pretty much everybody else needs to borrow money or to restructure their debt. Looking at what's next in terms of the region, I'm looking at it in terms of phases, and we're very much in phase one across the region, which is that governments are dealing with the crisis. They're extending the lockdowns, which now looks like it's going to be early May, mid-May in most cases. The Victory Day, which is the end of Second World War in the former Soviet states, is May the 9th. Of course, the parade in Moscow has now been postponed. But that's a date that a lot of countries are looking at. They're hoping that the lockdown will start to end on May the 10th, so the early May of traditional holidays. So we'll see. I mean, it's early days yet, but right now they're just extending, most countries are extending the tight lockdown up to that period, and are still having to apply more measures, financial measures to support economies, key parts of the economy. So we're in phase one. Phase two is, I believe, when we get maybe later in May, early June, there'll be a bit of breathing space, hopefully, and then we'll start to see the first adjustments to budgets and to maybe policy or priorities. So that's kind of when we will redo our forecasts, when we start to see what governments are planning to do and what specific measures they're put in place with regard to budgets and spendings and maybe tax changes or policy priorities. Phase three, I think will come after that, again, a period of reflection, looking at what the damage is, as it were, in the region, their own economies globally, and then leading to phase four, which will be a more comprehensive, more detailed review in the autumn, whether it's September or October. We're expecting really that's when we will get the more comprehensive assessment of what does all of this mean for each country, what do governments think it means for them, what will they do with their budgets in terms of the next couple of years, and that's when we will get the more serious look at our forecasts, and we will more comprehensively review our forecasts and our scenarios for 2021 to 2024. And phase five, I think, will be just dealing with the legacies, localization. Of course, will it be a big issue across the region? I don't think it'll be isolationism or protectionism, but localization. In many cases, it might be a subtle difference, but you can definitely see this coming. Obviously, a big priority in terms of investing in healthcare. We know that some sectors like logistics, warehousing, online services are all doing well and will continue to do well. So we start to be able to better assess where are the opportunities, where the improving opportunities, perhaps have a better idea of what sectors are being more damaged for longer. Again, leading to us being able to help our clients understand what this means for them over the next several years. And a reminder of the critical factors, which I think we're all very familiar with anyway. The COVID-19 goes without saying, global trend. Again, a lot of these economies are open for trade, but a lot of it though is to do with China. So China more specifically than global, particularly when it comes to coal from Mongolia, metals from most of the Central Asian states, and generally dealing with China is a key factor for most of these economies. The oil price, say, affecting the 4 key countries of Russia, Kazakhstan, Azerbaijan, and Turkmenistan. But of course, the contagion in terms of remittances, the currency impact, the regional trade, all of which are linked to, hydrocarbons in one form or another, budget expectations, confidence, how long it will take. You can see across the board, the market, IHS, manufacturing and services numbers have all collapsed. How quickly will they recover? So that is our first run through on the Eurasia Briefing. As you can see, we have made a first assessment of what all of this means for the different economies, financial positions, fiscal positions in the region. We will, I would expect that we will revisit all of this probably in the late spring or coming into later this quarter, when we start to see what governments do in terms of budgets and what we're better able to assess the impact on economies as we get numbers for April and for May. But I would expect that we will more likely get a more detailed assessment only in the autumn, when hopefully we'll be in a better position to assess the impact of COVID-19 in the world and where the oil price is heading for the next couple of years. But in the meantime, and in the next few weeks, we will be making more detailed assessments on a country-by-country basis. The first one is likely to be Ukraine very soon, but we will go through all of the countries and provide similar updates of what's happening in these economies and what it means for you as investors planning your work and your investment in these countries in the next couple of years. So thank you very much for your attention, and I look forward to presenting our next review on Ukraine. So thank you very much.